Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just now to go until the closing bell. And stocks, well, let's take a look at the popular averages. The Dow and the S&P 500, they're both basically flat right here. The tech-heavy NASDAQ in the red, it's down about 0.4%. Let's welcome in Jared Blickery, joining us to break down all the headlines. Jared, what are you seeing in the markets?
Bit of red right now, a little bit of green, we'll get into that, but in the majors we are looking at just a tiny bit of red. Dow down a whopping 20 points or 0.4%. You could basically call that break even. Here in the NASDAQ we are down off about 0.4%. Tech is really kind of the dog story of the day. And then in the S&P 500, also just barely down. You can see it's been a little green, mostly red, but only down about 7 basis points on the day. I did say that there's some green, and that would be the S&P 500 equal weighted index. And so this is kind of pushing back against the concentration narrative. We are seeing some sector rotation, and thank goodness for that, because that is the lifeblood of a bull market, according to Ralph L. Campora, godfather of technical analysis there. Here's a 10-year T-note yield. It is down 1 basis point to 4.18%. The 30-year down 1 as well to 4.85%, so not a lot happening there, or in the US dollar index. So a lot of markets just treading water today, and I think we're going to see some movement into some of the bigger reports, especially the big jobs report and CPI, but that's not for another couple days. In the meantime, we're just seeing some money go into healthcare. XLV, that is up 1.33% today. That is the number one performing sector this quarter since October 1st. Number two, we've got consumer discretionary up 1%, XLU almost 1%, that's utilities. Then it trails off from there. Real estate, industrials, and staples. To the downside, energy and tech have been trading places for that last spot in the S&P 500 large cap sector list. Both of those are the only ones in the red, and both of those are the only underperformers. And if we take a look at the NASDAQ 100, we're going to see some weakness in some big names. Broadcom down 5%. That's after 10 or 11% on Friday after earnings. Costco down 3%, but we do see some green on the board, and also in the Dow as well. And Procter & Gamble, kind of a safety trade sticking out. That's up 1%. Salesforce, one of the worst companies in the Dow this year. That's down 3%. But some winners, some losers, and I'm going to leave us off on our leaders, and we can see most of these underwater. Bitcoin taking another dive south since Friday. That's down almost 5%. Software, China, microcaps, IPO. So we're not seeing a lot of strength in some of the smaller names, but in some of the larger ones, we've seen healthcare and the like stick their neck out today.
All right, thank you, Jared. Well, the tech-heavy NASDAQ is the worst performer as bond yields tick up here, but my next guest looking under the hood when it comes to tech and is focused on AI and adoption and the implications for individual names. Join me now, we've got Chris Versace, Tematica Research Chief Investment Officer. Chris, always great to see you. Maybe start big picture, Chris. Final full week of trading for the year. As we head into the new year, 2026, how would you broadly say you feel about the markets? I mean, are you constructive, Chris, as we head in?
I would say I am cautiously optimistic. You know, the S&P 500 has been hitting some new highs of late, kind of bouncing around a little bit on those areas. To me, where I'm really kind of laser focused, given the market multiple, is prospects for earnings growth. Where are we going to see superior earnings growth? The secret sauce to, of course, multiple expansion and alpha. That's what we want to look for. So I'm looking for areas that are, poised to significantly drive faster earnings growth than the S&P 500.
What would be some of those areas? Would it be like the AI heavy names? Is that where I'm looking?
I think that's certainly one area, and it's an area that I'm kind of clued into. We see a lot of things are going on right now. There's questions over enterprise adoption, consumer adoption of AI. Is there the fundage, as we like to say, to pay for all of this? So, we kind of did some homework, and we looked back in the past about internet adoption, smartphone adoption, looking to see kind of, what happens in the first few years. When should we start to get a little worried? But I'll tell you, Josh, that it's not just adoption, because it's usage. If you think about the internet and you were to trace back the amount of data that is being consumed, created, pushed in, through, around the network, it has just continued to explode as more applications have become available, streaming in particular, because of all the content and all the data that video consumes. Now we step back and we think about AI transitioning from text to video, given the announcement with Disney and OpenAI next week. I think we're at the mouth of that starting to happen. So we continue to see a very, very positive multi-year outlook for AI, not only adoption, but more importantly, usage and what that means, digital infrastructure. That gets me back to names NVIDIA, Marvell, Arista Networks, those things that we have in the Pro portfolio at the street.
So you're positive on that AI story. The fact, Chris, though, that you are hearing about more companies tapping the debt markets to finance their AI dreams and hopes, did that have any impact on your optimism at all?
Well, I mean, it has to, right? Because you have to be mindful, just given what we saw back in the dot-com bubble, right? There were a lot of companies that were interesting stories that didn't pan out, and of course we saw them get washed out. So we do want to be mindful of that, but I think when we look at the adoption levels in the enterprise, and what we're on the cusp of really happening with the consumer, not just this holiday shopping season where there's all sorts of statistics from Adobe and others, but we're on the cusp of Apple bringing out a real AI-enabled Siri. That could start to turbocharge AI consumption at the consumer level, and we know whenever Apple does something, there tends to be a competitive response. So I think we'll see Samsung leaning in with their AI flavor, powered by Gemini, of course. So I think there's a lot of positive things on the horizon. I just think right now we're caught in this malaise.
Can I ask you, that malaise, does that help explain? Here's a name you like, NVIDIA, for example.
Yeah.
Now, you're going to end the year, NVIDIA's ending very respectable. I think we're up about 30% year to date. But lately, it has not been working. I mean, past month, you're down about 7, 8%, something like that.
I think that's true. I think that's
what
true.
Is that?
That's true for a lot of those names.
Yeah.
You could look at Marvell. There's questions about what's going on, even though I think the acquisition they made really shores up their position on interconnect chips. You could look at Broadcom, had a wonderful backlog level, stocks down.
Got whacked.
Down double digits.
Yeah.
Yeah. I mean, we're circling that one, just given the pullback, its position in custom AI, cybersecurity,
But you didn't
some
pull
other
the
areas.
trigger yet. How come? On Broadcom.
Yeah, so Broadcom reported last week, and what we're contemplating doing is realigning our overall chip exposure because of the pullback in Broadcom, because of the markets it would bring into the portfolio. Why didn't we do it is your question. Because we try to balance a combination of thematics, fundamentals, and technicals. And with Broadcom in particular, we were waiting to see, just given the pullback, did it hold support at the 50-day moving average?
That short-term trend line.
Correct, on Friday, and it did not. So we said, okay, let's wait and see.
That was a yellow flag to you.
Correct,
Right.
correct. So let's wait and see where the shares settle out. And today, as I was coming on to set, I noticed that, they're flirting with their 100-day moving average. So now we'll need to watch that level over the next couple of days. Does it hold? If it does, that could give us a signal that maybe we could start to proceed and tiptoe into the shares.
So you like NVIDIA, like Marvell. Here's another name, ServiceNow. I want to get your thoughts on. They're in the news, by the way. You saw
Yes, they
Bloomberg
are.
reporting advanced talks by cybersecurity startup Armis. Could be a deal here worth $7 billion. What do you make of that?
So we own ServiceNow in the portfolio, and that's another name that is kind of pulled back, especially today on this news. I like the transaction. I may not be crazy about the price tag. I kind of need to understand, the synergies that they can get by cross-marketing and other costs that they can pull out of the business, assuming that the deal goes through. But I think leaning into cybersecurity, nice complement to the existing business, and that's candidly a growth area. So we like that. It also builds on another acquisition that ServiceNow made earlier this quarter that kind of really pushes it further into cybersecurity. So this seems, if it happens, to be part of a multi-phase plan by ServiceNow management. And I think we'd want to understand the full plan before we draw any conclusions.
Another name I want to get your take on, only because it's a more recent move. You added to Welltower.
Yep.
I think today. How come?
Well, so Welltower shares have been pulling back. They had a great run. But thematically and fundamentally, we like it because there's a massive demographic tailwind, the silver tsunami, as they call it, with the aging of the population. But there's also a pain point involved. And you could do some quick Googling and you'll see that there's expected to be a shortage of senior housing by about 350,000 to 500,000 units over the next few years. Put those together, powerful combination. So that's why we like Welltower. But remember the comments I made about Broadcom, right? Shares were falling back. With Welltower too. Last week, our message was, if the shares test their 50-day moving average and find support, we would be likely buyers. That's exactly what happened on Friday. So again, blending the fundamentals, the thematics, and the technicals.
Finally, we're talking stock picks, but long-time market watcher that you are. What's your thoughts on this too? Race is on for the next Fed chair, we know this. CNBC reporting, you saw this headline, Kevin Hassett's candidacy received some pushback by high-level people. The concern, he's too close to the president. I'll ask you like this. Is there a candidate that you think the markets would prefer? Is it Hassett, Waller, Warsh? What do you think?
Not sure. And the reason I say that is I think over the next couple days, as Jared pointed out, there's a lot of data coming. A lot can change, and I think we're going to want to see how these guys and gals kind of stack up with what they think can happen with 2026. So, I don't think there's any one in particular. Candidly, if Bostic did it, I would have liked that because I like that guy. But no dice. So.
All right. Always a pleasure to see you, my friend.
Same here.
Well, crypto taking a hit again after a short-lived rally. Bitcoin falling once again in the last full trading week of 2025. And Yahoo Finance's Inez Ferre is here with more. Inez.
Josh, you're looking at Bitcoin that's below 86,000. I'm going to pull up a year-to-date chart so you can see Bitcoin down 9% year-to-date. But take a look at where we have been over the last couple of weeks, because Bitcoin has been unable to hold the 94,000 level that we saw just last week. So there aren't a lot of catalysts that are sending crypto higher. Look, you've got the Bank of Japan that may be increasing interest rates, and that would be bearish for assets like Bitcoin. You have liquidations, you have traders that are talking about trading volumes that have been depressed. You've got the lack of conviction when it comes to crypto. So what you could see with Bitcoin, for example, is some consolidation period. The same with some of the other tokens as well, as we've seen Ether down more than 4% today, unwinding some of the bumps that it saw last week. And then just taking a look also at the difference between what we've seen with crypto and what we've seen with the metals, which is like night and day. So if you take a look at gold, gold is nearing a new high. It is at 4,343. If we take a look at a year-to-date chart for gold, I mean, it's just unstoppable. You've got Wall Street that is bullish going into next year for gold. You've got the whole debasement trade that's going on with the metals, with silver as well, as we're watching silver up more than 115%. Year to date. Even the copper trade has been bullish this year because of demand, because of the tariff concerns, but because you've got hoarding that's happening in the US, but also because of the AI demand, because of electricity, the grid. All of that is going to require copper, and that's why we've seen the metals rally this year. Very different picture than crypto. Josh?
All right, Inez, thank you. Appreciate it. Coming up, no driver, no problem. Tesla shares riding higher here. We have the latest on its Robotaxi progress next. Tesla stock riding higher, briefly touching an all-time high. Company getting a boost amid positive developments in its Robotaxi business. And Yahoo Finance's Pras Subramanian joins me here with the very latest. Pras.
Yeah, the stock really bouncing higher here today. And you were talking about the news, the news being that over the weekend, a video was posted of a Tesla Robotaxi in Austin, Texas, without a safety driver on the streets, right? Just with nothing, no one inside driving around. And then it was confirmed by Tesla's head of AI that yes, they are doing this. And then Musk even chimed in saying, yes, we're testing out cars without the safety occupant, or whatever you want to say it, in the car, and that's the next step towards fully unsupervised robotaxis. Like that's the holy grail. What Waymo is doing now, right? They're already doing that now in certain select markets. So that's the sort of the holy grail there for Tesla. And we saw some analyst commentary today by Dan Ives talking about how heading into 2026, this marks a monster year ahead for Tesla and Musk as the autonomous and robotics chapter begins. In our view, we expect an accelerated robotaxi launch across the U.S. with importantly volume production of the Cybercab. That's the purpose-built, no pedals, no steering wheel car, starting in April-May timeframe. So all sort of good news there. Stock is sort of rallying at the right time. A big move to, like you said, briefly touching an all-time high, I believe. Is that what you said? 52-week high at the very least. So that's a big move there for Tesla today.
So is it a big move, Pras? Because listen, I'm watching this. Let's say I see this headline. Should I think of it's a big move technically? Is it a big move because it's just important they're hitting these milestones? How do you frame it?
I think that's the right framing, is the milestones. I think it's, in October of last year, we saw the Cybercab come out. People were saying, "What is this thing? It looks so space age. Is it going to be a pie in the sky type thing for Musk that he's been known to do?" Well, what happened is over the next year, you saw introduction of Robotaxi service in Austin that went off seemingly okay. They expanded it. Now you saw them expand to the Bay Area, and also they want to go to Nevada and Phoenix. And then just yesterday, we saw the fact that there's now the safety jar has been removed from the car. That's what Musk was saying in a few weeks that would happen, and then eventually it'll be fully unsupervised Robotaxi service. So I think it's a combination of they're hitting their milestones, they're making it happen, and we've seen some other journalists talk about who've tested the new FSD, and they say it's great. It made significant strides in making it smoother and just more operationally better. So I think that's what it's a hitting milestones, moving not moving the goalposts, but which is normally what people would say, but they're actually just kind of heading in the right direction.
All right, Pras, thank you, buddy. Appreciate it. Another development in the race for the next Fed chair, Kevin Hassett, once viewed as the clear frontrunner, is now facing pushback from people close to President Trump. That's according to CNBC. This is coming as President Trump says Kevin Warsh is moving to the top of the candidate list now. For more, bring in Yahoo Finance Fed correspondent Jennifer Schonberger. Jen.
Hey there, Josh. Yeah, that's right. While Kevin Hassett has been seen by markets as the top choice for the next Federal Reserve chair, a new report out today from CNBC says people close to the president are advising against it. And the reason behind that is because Hassett is loyal to the president. And so he is in favor of cutting interest rates. And the fear is that will he continue to cut interest rates, even if that is not a prescription that the economy requires, which could unleash inflation, pushing up bond yields, thus pushing up borrowing costs in this economy, the opposite of really what President Trump wants. Now, this as the president sat down for an interview this past Wednesday with former Fed Governor Kevin Warsh, who is also at the top of the president's list. If you take a look at odds now for who the next Fed chair could be, interestingly, Warsh now edging out the lead narrowly over Hassett, 47% odds right now. Of course, it's always a surprise whoever the president settles on. He is said to we are said to expect an announcement by early next year. Josh.
And Jen, while we have you, we also had some more commentary from other Fed officials today. What did they have to say, Jen?
That's right. We are hearing from a couple of different Fed officials today, notably New York Fed President John Williams, who was very upbeat about the economic outlook for 2026. He says the economy has turned the corner and that all the uncertainty that we had this year is sort of behind us and that we are poised to return to what he calls solid growth and price stability. He thinks inflation is going to fall to just under 2.5% next year. We're only going to see a one-time increase from tariffs as far as the impact on prices, and that inflation returns back to the Fed's 2% target by 2027. Now, interestingly, Williams characterized the rate cut last week as, quote, moving modestly restrictive policy towards neutral. That he characterized policy as, quote, modestly restrictive indicates to me that there is room for the Fed to cut rates further before they get to that so-called level of neutral, a level on interest rates designed to neither spur nor slow economic growth. Now, separately, we also heard from Boston Fed President Susan Collins, who said that her vote in favor of a rate cut last week was, quote, a close call. Going into the meeting, it didn't seem like she favored a cut. However, new data that she got leading up to the meeting was able to convince her otherwise. However, looking ahead, she says that she's going to need to see much further evidence that inflation is falling before cutting rates further. And lastly, we heard from Fed Governor Stephen Miron today, who reiterates that he thinks inflation is much lower than what current measures are showing because of the way they are being calculated. He doesn't see any tariff inflation, and he believes that rents are now growing at a level of 1% per year, and we will see that eventually show up in inflation measures, which will pull overall inflation down, which is his case for why we need more rate cuts now. Josh?
All right, Jen. Thank you. Great summary. Homebuilder confidence ending the year in negative territory despite inching higher in December. Rising construction costs, economic uncertainty, and affordability concerns continue to weigh on the housing market. Here now to talk about all of this, we have Jim Tobin, CEO of the National Association of Homebuilders. Jim, it is always great to see you. So let's get right into this, Jim. Builder sentiment, we are still stuck here in the 30s, Jim. Not great. What explains that, and what do you see ahead?
Well, hi, Josh. Good to see you and your viewers. We're still stuck in the uncertain times. This year we have been for now 12 months in a row stuck below 50%, which is our break even point. Actually stuck in the 30s all year. Just a year ago we were in the 40s. So we've seen a decline and then a stabilization over these last couple of months. It's uncertainty. It's mortgage rates stuck stubbornly above 6%. And it's also the pace of construction. We've seen a lot of people trying to eat through the inventory that are already in the ground. So it's a combination of things that are really keeping the market constricted at this point and unable to kind of break out and into that positive territory.
How much relief, Jim, is your industry expecting from the Fed, which just did deliver another cut? What are you seeing and hearing?
Well, certainly the latest rate cut is good news on the construction side. Construction lending loans are pretty much directly pegged to the overnight rate. So that is good news for those who are getting ready to start some projects or starting to pencil some out for next year. Mortgage rates, we expect them to follow a little bit. Obviously, we'll see what the bond market does as they continue to read on the overall economy and debt and deficit. But we don't expect the Fed to cut again in January. I think they're going to take a wait and see. Your last report there talked about more data having to come in about whether inflation is tamed. I agree with the Fed governor who talked about shelter inflation starting to come down. That is the last most stubborn piece of the inflation puzzle as rents continue to fall. I do believe that's going to help that overall inflation number get closer to that benchmark rate of 2%.
Just to put a number on it, Jim, so the 30-year fix here is at 6.29. That's according to Mortgage News Daily. You have smart economists on staff. What do they see, Jim, over the next 12 months there?
I think we're going to be hovering right around the same level for most of, if not all of 2026. We don't expect our mortgage rates to get, consistently below 6% and into those mid to high fives until early 2027. Now, that said, if we do see the pace of production pick up, we do see some relief from tariffs, or at least a lessening of the potential impact on tariffs. I do think that we could see some rates go down in the end of 2026, but we think we're going to be bumping along here at 6% or even a little bit higher for the better part of a year.
Jim, let's talk about tariffs because you call that out. You say tariffs are having serious repercussions. Walk us through that, Jim. How so?
I think it's more from the macro effects of the tariffs. It's just the uncertainty of what tariffs are going to be. For months we have predicted that the tariffs are going to add, $10,000 or $11,000 to the cost of a house. As I travel all over the country, I have heard, from our members that impact is much lower, maybe $2,000 to $3,000. So there is an impact, but it's not as high as I think that a lot of people have foretold. Yet, it seems like everybody keeps talking about, but tariffs are yet to take effect. Yeah, tariffs really haven't bitten yet. We're going to see that in the next quarter. So I think that we're still waiting to see if tariffs are really kind of where they're going to be, or are we going to see them bite a little further? I'm hoping for the former, that we've seen the worst of the tariff impacts and we can absorb those into the economy. I think Governor Myron said that already, but we'll see. But until we get that answer, I think that's where we're going to see this real uncertainty continue into early 2026.
This was another interesting stat, Jim, stood out to me. 40% of builders cut prices in December. Is that just seasonal, Jim, or no? Does that suggest something more long-lasting here? What do you see for home prices ahead?
It suggests to me that there is inventory that is sitting idle, that mortgage rates have continued to keep people on the sidelines. Of course, we've heard that the job report, while we haven't seen government data for a little bit now, we expect that the job market is very soft. So it's hard for people to make that move either for a new job because there aren't any, or because they're not confident in keeping their own job. So the job market itself, I think, is keeping people on the sidelines. Therefore, we're seeing those deep discounts offered by a large percentage of builders to get that inventory off the marketplace so they can go ahead and start planning and building for 2026.
A bigger picture question for you, Jim. You know this. Affordability is a key issue right now for a lot of Americans. Housing is front and center there. And the question is, to address that, how do we unlock more supply in this country? And I'm just curious, Jim, when you think about that question, what are the big bottlenecks to that, Jim? Is it zoning? Is it labor? Walk us through it.
Yeah, first and foremost, it's land use policies at the local level of government in this country. We have got to get local policymakers and decision makers to open more land and be open to more home building, because we know that if we build more housing, we can lower costs and we can make housing more affordable. So we've got to get that local government to open up that land, which means that they have to say yes to more housing, and they have to say no to the NIMBYs out there, the not in my backyarders, who refuse to let people have the same opportunities that they had when they were new to those communities, and let people build and have a piece of the American dream. Next, of course, labor. Labor is one of the largest impacts. We've got to train more skilled laborers in this country to build housing more affordably. And we have to have a reliable and affordable building materials supply. And that goes to, speaking to tariffs, it goes in trade, but also our domestic supply and doing what President Trump wants to do, which is increasing our economic output of building materials here. And then finally, it's making sure that we have a good lending rates. We talked about the Fed actions dealing with construction loans. Mortgage rates need to come down next, kind of the financing piece, the lending piece of the equation. If all four of those can get moving in the right direction, that's what's going to unlock the housing market, and that's going to unlock home construction in the country.
Finally, Jim, you mentioned President Trump there. I'm just curious to always get your check on this. His immigration policies, Jim, what kind of impact is that having on your industry, and how are they navigating it?
Well, very carefully is the answer. There have been more increased raids over the last couple of months. Hearing from many members from across the country that are found their job sites severely constrained by either the potential of job site raids or raids themselves. So that's why it's really important for us to get to comprehensive immigration reform, get Congress to work together to actually come up with a solution. There's legislation right now in Congress that would do that, that would find a pathway forward for those that are here in the country, also allowing people to come in here and work in the industry legally. Critically important that we do that. But we also have to train those that are here, those who want to work in this industry, rededicate ourselves to making the trades great again and putting the resources and the energy behind creating opportunities to train more people in the skilled trades. It's a whole of government approach when it comes to the labor equation. Jim, always great to see you. Thank you, sir. Thanks, Josh. Coming up, a look at Yahoo Finance's Company of the Year, OpenAI. Hear from the AI giant's C-suite. That's straight ahead. Now time for some of today's trending tickers. Going to start here with Kellanova. The owner of brands such as Pringles, Cheez-It, Pop-Tarts has officially combined with Mars. The acquisition of Kellanova expands the Mars portfolio, which already includes brands like Snickers and Twix. The $36 billion deal was first announced in August of 2024 and received all required regulatory approvals earlier this month. Next up, Bristol Myers gets an upgrade over at Bank of America, the firm lifting its rating on that drug maker from neutral to buy. B of A Global Research citing the strength of the company's research and development pipeline. They also highlight a favorable risk reward as Bristol Myers approaches a catalyst-rich 2026. And lastly, Goldman Sachs gets bullish on several consumer-facing names, the firm lifting its rating on Marriott, Hilton, and Las Vegas Sands from neutral to buy.
Goldman pointing to Marriott as having one of the highest exposures to the upcoming World Cup. Hilton is seen as well-positioned to benefit from ongoing outperformance in the higher-end consumer, and Las Vegas Sands is expected to have its Macau gross gaming revenue see sustained momentum into 2026. Well, OpenAI has been named Yahoo Finance's 11th Annual Company of the Year award. It undeniably led the market narrative for investors in 2025 when it announced big deals, and Yahoo Finance's executive editor Brian Sozzi sat down exclusively with OpenAI CFO Sarah Friar to go inside the company's next AI chapter as it faces a growing threat from Google and hit code red.
There's always a very clearly defined exit criteria when you go into a code red. Like when I've seen them not work in prior lives, different companies, it's usually because the exit criteria was either too nebulous, like no one really agreed on it as you set out to do the code red, or it was almost like so aspirational that it became like, a year plus in the making. That makes no sense. I think what we've done well here is you have an exit criteria really around what is the feel of the next kind of model for ChatGPT? How's it going to present to consumers? How do we think about balancing things like personality, use case, and so on? What I get excited about in ChatGPT, right, in where we're headed into 26, is a couple of primitives. So number one is that we're making sure that you're making more use of personalization so that memory makes ChatGPT work for me, Sarah, you, Brian, but not generic. I think the second thing we're really focused on is how do we become a little bit less insular? So it's not just ChatGPT by itself, but how do we offer more apps within ChatGPT? So for example, if I want to book travel, I can now call upon Expedia or Booking.com to book travel inside of ChatGPT. If I want to do more creative design work, I can call on Canva, and you'll see us do that with more companies. And then conversely, if we're using an app and you want to pull that up in your Atlas browser, you can now pull on intelligence in the sidebar to help work with the app that you're in. So that's a way to go from being more insular to much more of a platform. And then the final piece, which I think probably resonates most for the consumer in a way, is ChatGPT becoming that super agent. So it might be my concierge doctor, it might be the tutor that I use with my kids or even for me so I can learn more, or it might be my travel agent or my stylist. You can see it working today in study mode where ChatGPT doesn't just manifest by giving you the answers. It actually works in this more Socratic way as a teacher. And I love that because it keeps testing as it goes to see if you're learning. And that might be because you're a university student. I've got one of them right now, two of them right now, doing finals. Or it might be as a later in life learner, for example, that's decided to switch careers. But that's that super agent that I think we'll see a lot more of in 2026.
Clearly, you're putting a lot of capital, a lot of focus during this code red moment on ChatGPT. Does that mean we will not, and you and I talked about this, I think, at the Goldman conference, does that mean we will not see that hardware device from an OpenAI over the next year? Like, is that pushed further out?
Brian, I told you you're not allowed to ask me about the hardware device.
Well, I didn't ask you what it may or may not be. I just asked if it is coming, No, the hardware is still very much coming. Hardware has a longer gestation period is usually how I think about it, right? It was one of my learnings at Square. Software, has this very fast-paced, literally you can turn out software in days, weeks, months. And in fact, now with our Codex product, you can really do it in hours and it'll do it autonomously for you. Hardware, you have to make decisions over quarters, years even. And so that device is still very much on track, but will be, a year plus in the making. So no changes right now, no announcements to be made, or Johnny Ive will come and get me. But we are quite excited about what that substrate can mean for how people experience AI. Like I think as we talked about at Goldman, the era of the internet and then mobile really had us think about, a flat device where we kind of talk with our thumbs. AI is multimodal,
we can experience it in this much more human, intuitive way. We can talk to it, we can listen, it can see. We just don't do that enough. It's not yet in our vernacular as individuals, and I'm pretty excited for what a new hardware substrate can bring.
Fair enough. I want to see if you can help me settle some of these debates, because I get these questions. I'm like, all right, well, I'm going to put these to Sarah and very simply see what she has to say. Does the next update on ChatGPT put you ahead of Gemini 3?
I think this model kind of chicken egg, who's ahead, or some chicken egg's not quite the right phrase, but like who's ahead, in some ways, I think is just going to keep happening. Look, our models are incredible. I am pretty excited for what the reasoning part of this next model is going to bring, particularly in an enterprise setting, actually. I think actually one of the biggest unlocks is less about who's got the best model and the most intelligence, but how do we actually help people use it in a much more intelligent way, right? Our model, I already said, it's like PhD level in everything, and yet people still largely use it for things like, what's the weather in San Francisco today? Or, important things in life, but like, what could I buy my 18-year-old son? It's not quite what I'd probably ask, someone who's sat down next to me and is a physics expert in black hole theory. And yet that's kind of what we're using it for. Beyond the model layer, as I've talked about, we have become much more sophisticated. So it's about the APIs. How do people access our products? API growth has been probably one of the biggest surprises for me this year in terms of our overall P&L. Then it's the application layer. How do people feel and touch the app? And then finally, that kind of substrate layer that we talked about with consumer hardware. And so I think we're much more multidimensional today. And so getting into like who's got the best model is probably something that keeps changing. But I do think it's incredibly important that we remain state-of-the-art frontier. And of course, I always think we have the best models.
Next one for you, and you've heard this before. OpenAI has $1.4 trillion in various commitments, and if it does not meet expectations, it's going to bring down the whole tech sector. What say you?
So I think, first of all, people get way caught up in the fact they think that's all happening today. As I've talked about, our compute strategy has to have a multi-year lens to it. So it's about compute we will buy over 5 years, 7 years, even 10 years. So when you hear a lot of these big numbers, think about them as much more spread out over time. Second, many of those numbers, in some ways, there's a double counting going on in the press. So when we talk about taking down, say, a large data center site with our partner Oracle, we have to be able to put chips into those data centers. And so often we will then go do a deal with, say, an AMD or with an NVIDIA, or even our own chip hardware, by the way, because we know that's now going to go into that data center. The press often hears both numbers and kind of says 2 + 2 is 4. And I'm saying, no, it's 2 and 2, because it's the same fully loaded data center with chips in it that's going to be our compute future. And then beyond that, of course, we need to keep building our business model to meet our commitments. But thus far, we are the fastest growing consumer platform the world has ever seen, the fastest growing enterprise platform the world has ever seen. Just even in my time of looking at the company, in 23, we did $1 billion of revenue in 1 year. In 24, we did $1 billion a quarter. We just a couple of months back hit over $1 billion a month. And the model and the P&L has continued to build since then. So we're rising to meet that challenge. And I think in a world where we're headed towards AGI, AI, mass intelligence out there in the world, we just see no reason to stop right now in terms of the requirements and the need for compute.
Coming up, a deeper dive into Yahoo Finance's Company of the Year, more market domination just ahead. OpenAI is shaping the market more than anyone this year, and it's Yahoo Finance's 2025 Company of the Year. OpenAI's reach is reverberating through the entire tech landscape, not just with its AI, but also massive deals with some of the biggest names in the space, including NVIDIA, Microsoft, and Oracle. For more, we're bringing out Corey Johnson, Chief Market Strategist at Epistrophe Capital Research and host of the Drill Down podcast. Corey, it is great to see you, my friend, as always. So let's talk about OpenAI. Yahoo Finance did crown them the Company of the Year, Corey, and why not? Sam Altman is a force, sure. Interested, Corey, to get your take on On maybe the competitive landscape Altman does find himself in. You think about Google Gemini, Corey, rave reviews. Google has the users and the distribution. It's free. How do you sort of assess the competitive landscape? Is there room, Corey, for multiple winners in your opinion here?
There may be. I mean, here's why you're so smart, Josh. I know you like sentences that start like that, but you guys picking this company is so on point, because what happened during the course of 2025 is the global economy went from a certain kind of financial risk and a certain kind of business risk to a risk of OpenAI performing or not performing. I know what I've said is we went from the moment that some bad decision by Jamie Dimon could put the world's economy into a tailspin. Now bad decisions by Sam Altman could do that, because so many companies rely on the ability of OpenAI to spend the money it is committed to spend. And if OpenAI screws this up, lots of companies are going to be in trouble. And I think that really the overall economy, certainly the markets, could also be in for a lot of pain.
Well, let's talk about this more, Corey, because I want to bring up Oracle. Now, you're a shareholder. Yeah. You're a believer. Yeah. It has been whacked, Corey.
Completely biased.
Talk about that, make the case, and specifically how it relates to OpenAI, because there are these questions, Corey, whether Oracle is overexposed to Sam Altman's company. What do you think?
So I think that, if there's a general notion of what if we're in a bubble, is this an AI bubble? What about these deals companies are doing with each other? Is this a bubble? Is it a bubble? Is it a bubble? And I think what isn't happening is a careful look at what's actually the way Oracle is going to be recognizing revenues, the way that Oracle's CapEx is going to work, and how they have very carefully orchestrated this such that through the use of leases, through the use of things that they don't have to actually commit to, and certainly don't have to commit their balance sheet to, that the things that show up on their balance sheet as expenses, capital expenditures in particular, only show up the moment before they will be turned on and handed over to customers, where the revenues will show up. And so if Oracle does execute in the way that they've explained that they will, the exposure might not be as bad as it would be if it were some other company going out there, buying some land, building a factory, going out and trying to find customers, and then hoping to fill them. Which is to say the duration of the exposure is supposed to be quite short. And I think that for Oracle, again, if they do that, and right now the market is either not doing the work to figure out what that is, or which is what my suspicion is, or doubts their ability to actually do it, we shall see. But my bet has been, and I'm completely biased here, but my bet certainly is that Oracle is going to do what they've said they're going to do, and they're going to do what they've historically done, which is handle a little bit of debt. Even, they've used debt really cleverly in the past. They bought PeopleSoft to grow their ERP business. They used some debt just generally for corporate purposes to grow out their data and cloud business. They've used debt to buy other companies to change the nature of what Oracle is. They're using debt right now to take care of this great opportunity. I mean, let us not forget that all those competitors out there, Microsoft, Amazon, Google, presumably IBM and others, were chasing after these OpenAI deals. Oracle got the deals that nobody else could, and yet the stock's gotten beat up for that. I think that betting against Oracle's sales team has always historically been a bad idea. We'll see.
Corey, we did get another point of view on this. We heard from Gil Luria recently, smart analyst, thoughtful guy.
Love Gil.
You love Gil. And we wanted his take. Now, Gil is not a fan of Oracle. He's neutral. He tells his clients, stay on the sidelines. Take a listen to what he had to say, and then we'll get your response.
Microsoft is front of the line. Microsoft, who owns the biggest part of OpenAI, is front of the line. They'll get paid first. If there's something left over, I'd argue that Amazon is probably next. Maybe after that is Oracle, which is to say the $300 billion isn't going to materialize.
What do you make it? So $300 billion not going to materialize. What do you think, Corey?
Well, I mean, they've got contracts with their customers. They've clearly vetted the customers that they want and not had the customers that they don't. But again, this is why your choice of OpenAI is so important. Is OpenAI really going to stiff and not be able to pay their bills? It's a question. It's a reasonable question, but it's not just OpenAI. Their customers are companies like NVIDIA. Their customers are companies like Milwaukee Best Tools. I mean, they have so many varied customers that have deep pockets that I would expect them to get paid in almost every occasion, and that the risk does not entirely sit with OpenAI. But yeah, if OpenAI goes belly up and can't pay its bills, Microsoft's going to be in trouble too.
Let me ask you, this broader AI boom bubble debate, when you hear of more companies and they're tapping the debt markets now to finance these AI ambitions, does that cause you to reconsider that debate at all, broadly?
You know, debt works both ways. Leverage works both ways, right? It works to help you do great things greater, and it can work to blow things up when things go bad. So I think you do have to look sort of case by case at what's going on here. But when I look at a company like Oracle, if Oracle couldn't give them a 12% return on invested capital, which is what they've averaged the last 5 years or so. If you tell them if you spend $100 billion, you can make $12 billion in profits, Larry Ellison and the management of Oracle is right to say, well, I'll give you $200 billion, give me $24 billion in revenues, or in returns, in ultimate returns here. So I think that, if their cost of capital is 3%, if their return on invested capital is 12%, why wouldn't they take bigger bets to get that done? Yeah, you got to be smart. You got to pick the right customers. Well, who's smarter than the folks at Oracle at managing this and taking advantage of this business opportunity? They have captured the biggest contracts out there. They have so far done a good job of executing those contracts. They're financing that using debt at a low cost of capital. That's business. It's smart business.
Corey, finally, so we talked to OpenAI, we talked to Oracle. I want your final take here on Broadcom. Hock Tan's company, they report, they get whacked. Give me your take, Corey, on the report, the investor reaction, and what, if at all, do you think that tells you more broadly about AI infrastructure demand right now?
Look, the numbers for Broadcom looked really good. The pricing of the stock was something people could have to figure out. It was an expensive stock, maybe going into the print. But I think that because this is what happened with Oracle and Broadcom and Ciena the same week. Ciena, I don't know if I've ever heard a bullish conference call like I heard from Gary Smith at Ciena last week. And yet that stock got whacked the day after those fantastic numbers were reported. It seems that the market has a narrative it wants to apply to any of these companies, regardless of the results that they show. Oracle's results were really good, right? Broadcom's results were really good. Ciena's results were fantastic. All those stocks selling off. Again, it's the market narrative that's slapping the stocks rather than the information emanating from the businesses themselves. And I will say that, for investors out there, and I don't give stock advice, but there are those moments in investing when the companies are telling you one thing that goes against what you expect to hear. And those are the moments you got to reevaluate your positions, both on the way up and on the way down.
Corey, we are always lucky to have you on the show. Thank you, sir.
Oh, I'm lucky to be here. Good to see you, bud.
We are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.